Hello and welcome to Farm Management Fridays. My name is Caitlin Davis, the La Crosse County Extension Agriculture Educator. Today's topic is navigating your farm business through 2021. Before we get started, I'd like to draw your attention to the link in the meeting description on your screen. Here you'll find a link you can use for our Q&A. You may have to click the See More button to access it. Please use this link to submit any questions or comments for today's speakers. I will turn things over to our moderator, Katie Wontok, the Dunn County Extension Agriculture Educator, to introduce today's speakers and begin our session.
Thank you, Caitlin. And welcome, everyone. Today, we are joined by two of my colleagues, Dr. Kevin Bernhardt and Dr. Mark Stevenson. Dr. Kevin Bernhardt is a professor of agribusiness at UW-Platteville, as well as UW Extension's farm management specialist. His teaching, extension, and scholarly interests include farm financial analysis and management, risk management, and commodity marketing. An Iowa native, Dr. Bernhardt received his BS degree from Iowa State University, his MS from North Carolina State University, and his PhD in agricultural economics from the University of Nebraska. Welcome, Kevin.
I had to unmute myself. Yeah, glad to be here, Katie.
Now, Kevin, we know that 2020, of course, was a challenging year. And this new year brings a clean slate. It's all about new beginnings and a fresh start and maybe some change in our coming year. So why don't you kick us off and tell us how we can navigate and help farmers through their business here in 2021?
Oh boy, we could spend the whole hour talking about the change from 2020 to 2021, couldn't we? I mean, it's been quite a year in multiple facets. It's been quite a year, and farm management is one of those as well. I mean, we've seen a rocketing up and down volatility of prices. Lots of new government programs that came out to try to help us through this pandemic. The pandemic itself, of course, and the disruption that it caused. Was listening to a program yesterday where they were talking about the meat packing industry and how hard that got hit by COVID. And it's not over yet. I think Mark's going to join us here shortly, and I think he'll probably talk to us a little bit about, we're not past it yet. We all want to be, that's for sure, but we're not there yet. And the other thing I would say, Katie, too, is it's not just because 2020 was such an odd and weird year that we have a focus on what to do for farm management in the next year. That's always the case, right? I mean, every time we go into a new year, we have new challenges. Something is going to happen that we didn't expect. Black swan events. Or just normal volatility that we face. And so farm management, just the need for it, the need to get better at it just grows and grows and grows. I think, Katie, where I'd like to start this morning is, I do have the ability to share screen, I take it, right? I'm going to start this morning with a few PowerPoint slides that will show some actual results for farms. Let me bring these up so you can see what I'm talking about. Are you seeing a PowerPoint slide there, Katie? Yes, okay. All right. So this is a database of farms. These are dairy farms from Wisconsin. These come from the Farm Bench database that's maintained by the Center for Dairy Profitability. And this is farms from the years 2015 to 2018. So a couple, I don't have the 2019, obviously we don't have the 2020 data yet. I don't have 2019 in there either, but we have those 4 years of 2015 through 2018, which actually were not good years, but they were consistent years. So you see kind of a common picture. But what I've done with this is try to tickle out of this data. Is there a difference among farms that are of the same size? They're from the same geographic region, Wisconsin, from the same type of industry, dairy farming, and therefore from similar herd sizes. You can see the herd sizes at the bottom, 0 to 72 cows, 73 to 129 cows, and etc. And what I did is I split this database of actual farms into thirds. And so I have a top third of farms And the split was caused by whatever their return on assets was. So the top third return on asset farms are what I'll refer to as the top, or the top third. And then there was the middle third, which I'm going to just leave out when I show you these slides. And then there's the bottom third of farms as measured by return on assets, a measure of profitability. So you see on the slide there, the dark black line that's in the middle, that's the average return on assets for farms of those different herd sizes. And you can look at it, it's not anything to write home about, right? And we knew it wouldn't be. If we look back at 2015 to 2018, those were not the best years. And so we're just a bit above zero up to about, what is that, about 3% or something like that for the largest herd sizes. And then you see where the blue line on top is where the top third farms begins. So it's from that line on up. That's the top third of farms. And the red line, the bottom line, is the bottom third of farms as measured by return on assets. And it starts at that red line and goes on down. So I'm going to hit my button here and you'll see a better picture of that. So that blue area is where all the top third farms was in those different herd sizes. And the gray area there is where all the bottom third farms. So all the rest of the data you're going to see is going to be information based on the farms located in either that blue, a solid area, or that gray area. So what's the average of that? So if I look at return on assets for the top third of farms, there's the average. That yellow line is the average for that top third of farms. And that red line is the average for the low third of profitability farms. So now I want to kind of tickle out, what might have caused that difference and what does it imply about farm management as we go forward. So that yellow line and red line is what I'm going to carry forward. There it is, that same yellow line, that same red line. And these are the return on assets. So for, let's take the third category, that 130 to 337 herd size of cows. The average of the top third of farms was 6.25% return on assets. And the average of the bottom third for those 4 years was negative 5.68%. Well, that's quite a difference. And if we look at what those differences are, 7.6% for the smallest herd size, and on up from there, those are some pretty substantial numbers. In fact, what I did next is I took that return on assets, these are from actual farms for those years, that difference times whatever the average assets were for those farms, here's that difference. So that, this slide shows how much more revenue was generated by those top third farms in each of those herd size categories. So for 0 to 72 cows, I guess I should say 1 to 72, right? We're not going to have 0 cows, but 1 to 72 cows, $132,000 more. Now for that size of herd, I think the median was about 65 cows, something like that. For that size of herd, that's a substantial amount of money. And you get up to the large size, of course, that's a very big number, but that's, all the herd sizes from, I think the biggest one was 7,000 cows or something like that. So that's, don't be too impressed by that large number because you're splitting it by a lot of families too. But anyway, the point is those are some pretty substantial numbers of additional profitability that those farms are getting compared to their cousins that are in the bottom third. Well, what creates a return on assets? Now, there's a lot of things that create that, but here's some of the bigger ones: price, production per cow, production being sold, and cost of production. So let's tickle those out a little bit and see if we can get any information about where this additional return on assets is coming from. And again, as we're going through all of this, I want everybody out there to be thinking about maybe even jotting some questions down or jotting a couple bullet points down for yourself. What are the implications for farm management in this case, in these cases? Well, here's price. So the top yellow line is the average price received over those 4 years by those farms that were in the top third as measured by profitability return on assets. And the bottom red line is the average price received by the low third farms. So there was a difference in price. Now that difference was somewhat large at the bottom set. And I think the reason for that is we had some of the organic farms that were located in that small herd size set that had some very high prices, and that probably dragged that upper end up a little bit. But for the rest of them, you see a fairly consistent difference of somewhere between 70 and 80 cents or so per hundredweight. So not a lot, but yet when you take that 70, 80 cents over all the hundredweights produced in a year's time, it can start to make a difference. And all these are based on annual averages. Why might that price be larger? It could be a quality of milk issue. It could be a volume issue potentially, although they are all from the same herd size. There could be some reasonings there, but it could be marketing, some additional marketing that took place to capture prices when they were there. Mark's going to talk more about that here today. But for some reason, overall, they were able to achieve about a 70 or 80 cent difference. And remember, this is over 4 years, so it's not just a 1-year aberration that you're looking at. Well, what does that mean in terms of additional revenue for those top third farms from price only? So I held production constant and I held the herd size constant. So I was multiplying everything times the same numbers within each herd size. And this is how much, roughly speaking, you were additional revenue that was coming from price alone. 22,000 for the smallest herd size, 11,000 for that largest herd size, etc. So a fair amount, that 60 cents doesn't seem like much perhaps, but when you put it across all the milk, it starts to add up. Well, production was one of those other drivers. We always talk about production. It's a major portion of our education that we learn, the different practices we put in place, the technology we adopt. Does it make a difference? Are we putting our time in a good place? Well, here, it doesn't look big here when I look at pounds per cow. 967 pounds per cow, 1,640 pounds per cow per year difference between the top third and the low third farms. And if you think about it in terms of pricing units, put the decimal point over a couple places, then instead of 967 pounds, we're really talking about 9.6 hundredweights per cow per year. Well, that doesn't seem like very much. But again, it's 9.6 hundredweights for every cow, and you're multiplying that by price and so forth. What does that mean when we take it out in terms of additional revenue? Well, there it is. So it's not a huge amount. In other words, production differences are not creating a huge difference in terms of the top third versus the low third, but it's some. And I think one thing that is a theme through all this is there's not one silver bullet for how to be how to get higher profitability. It's a meticulous attention to a lot of different things. Production is one of them. So squeezing out those extra hundredweights is giving you some more production. 9,000 for that small herd size, for that 130 to 337 herd size, it's another $8,000, etc. So it's something that's there. Now here's the big one, cost of production. Gosh, don't you hear the farm management folks? We just can't hardly have a conversation without talking about cost of production. And there's a reason for that. It makes a big difference. The top third farms is that red line again, and here is their total cost of production for everything. So this is all variable cost, all fixed cost, including unpaid labor and management. So it's all put in there so that we can have a comparison across farms. And the yellow, here the lines are flipped. So the yellow line is the one on the bottom, but that's the top third of farms. So the top profitability farms had the lowest cost of production, as you might expect. The lowest profitability farms, the red line, had the highest cost of production. And those differences are substantial. That is per hundredweight. So you take that across the number of hundredweights being sold each year, and that's going to start to make a big difference. And so let's look at the additional revenue of the top third farms, and there it is. So now we're seeing some pretty good sized numbers that is based on cost of production differences. Now, I think this, Katie, is one of the places where farm management is really a big hitter. Is cost of production is one place where the management can make a difference. Yes, it could come from the resource base you have. Some people have higher quality land and so forth, and you can't do a whole lot about that, right? It might be a climatic thing that you can't do a whole lot about. There may be some other infrastructure things going on in your region that make a difference for cost of production being higher in one region compared to another because of what's just going on with the infrastructure in that area. Certainly there are those causes too, but there is also a lot of cost of production that can be attacked, can be improved over the years with some management practices. And I think this slide here shows that that might be time well spent. Certainly a lot of that additional revenue can come from cost of production. So when I kind of put this together, that top row that you see goes back a few slides. This is the one that said this is the additional profits that a farm is getting because they're a top third farm versus being a low third farm. And then the middle three rows show approximately an estimate of how much of this difference. So if I look at the smallest herd size here, $132,000 more is what the top farms, third farms are getting. How much of that is coming from price? About 22,000 of it. How much of it is coming from production? About 9,000 worth. How much is coming from having a lower cost of production? About 75,000 worth. Now this doesn't account for everything perfectly because these estimates, I had to fix the price. I had to fix the production amount, and it didn't change by farm. So you lose a little bit in that. And the amount lost is what's shown here at the bottom. But I think there's enough information here to give us a good, strong feel that price, production, and cost of production are three biggies. And there's a lot of farm management within each one of those three. And of these three, certainly the cost of production is a big one. Price is a good, significant one, and production is right there too. So there is a place for farm management. Now the question might come up, well, is it farm management that made these differences, or is it something else beyond farm management? There has been research that's been done that shows that yes, farm management makes a difference. That same research often shows that there's not just one thing that you can do that's a silver bullet that that's going to make you better than everybody else. It tends to be more a across the board, meticulous attention to details that creates that better situation for a farm business compared to some other farm business. So the path, Katie, actually, I have a question for you. Do you want to go to the path forward here now, or do you want to, I think Mark has joined us. Do you want to jump back to Mark to talk about 2020 and
Well, Kevin, I've got
implications for
a couple
2021?
questions for you. You talk about farm management and how the price and cost of production and these are, are parts of that. Can you maybe just take a minute to define what you're calling farm management? What are some practices that farmers maybe should be doing if they're not doing? What is all included in farm management that you're talking about?
Sure, absolutely. Farm management, a big part that I'm involved in personally, one of the things that I do a lot with is farm financial management. So farm financial management has many parts. So if I'm one part of that, to break it down into two pieces, one of those pieces is looking backwards. So how have I done in the past to create the situation that I'm currently in? And the two big things there are the balance sheet and the accrual income statement. So the balance sheet is showing me how am I growing my equity. I want to grow my wealth, right? I'm not in this just to be just to have fun only. I also want to grow my wealth, have retirement, and all those good kind of things. So the balance sheet's going to show that for me. The income statement, we refer to that as financial position. The accrual income statement shows financial performance. So that is going to show me how I did this last year in growing my wealth, in getting profitability. Now, the end result of those two is how's my equity growing and what kind of profits did I have this last year? But the farm management part of it, Katie, is can I look back into those statements, especially when I compare them to other peers, especially when I compare them to the past? Can I look back at those statements and get some information for how to change my farm management in the future? Give you one quick example. One of the drivers of profitability is being able to turn your assets into gross revenues. If I don't turn my assets into gross revenues to start with, I can guarantee you I'm not going to have any profits, right? So I have to turn those cows and tractors and land. I have to work those assets and turn them into gross revenues to start with. There's a measure for that called the asset turnover ratio. So I can look at my asset turnover ratio. I can compare it to what it should be by industry standards. I could compare it to my peer group. I can compare it to myself historically. And if it's not where it should be, then I want to jump into that asset turnover ratio. And what I'm going to do tomorrow morning after breakfast is I'm going to go out and I'm going to see, do I have some assets that are not working very well for me? Do I have some cattle that are not producing? Do I have some land that's not producing? Do I have some underutilized machinery? What can I do I either can get rid of those things, or can I do something to make them more productive so that they're generating more revenues? So that is a farm management implication. And that's just one example. I could do the same thing with efficiencies and so forth. The other half of that is looking forward. So I just had a presentation with you again yesterday, Katie, talking about cash flow budgeting. In fact, it's one of our topics coming up here in one of our Farm Management Fridays too here in the future. And cash flow budgeting is a way for me to plan what's going to happen in the future. And I might be doing some strategic changes on my farm, or maybe I'm just doing some efficiencies this year. But either way, I can plan what I'm going to do. I can watch that plan as the year takes place and make adjustments accordingly as to whatever the world gives me in terms of prices and other kinds of issues that might come up. That's another way that we could use farm management as well. So that's just the farm financial piece. There's also risk management. There's commodity marketing management. Those are other areas of farm management that can make a difference.
And thanks, Kevin, for that. Yeah, a lot of people think it's maybe just the finances. And so it's great to kind of explore all the different aspects of farm management. So.
Absolutely. Yeah.
With that, I think we'll maybe transition to Mark, and then we'll come back and look at that path forward of your presentation in there.
Sounds great.
So next, I would like to introduce Mark Stevenson, who is the director of the Center for Dairy Profitability. He is an agricultural economist whose area of specialty is dairy markets and policy. And with the University of Wisconsin, Mark conducts and coordinates research and outreach activities related to the dairy industry. He is involved in applied research at the firm level, including milk assembly costs, processing costs, and efficiencies. He's also active in sector level performance, including dairy policy and price forecasting policy and price forecasting. Please help me in welcoming Mark Stevenson to our webinar this morning. Thanks for joining us.
Oh, thanks, Katie. I appreciate that. And I'm glad to talk with folks this morning about this. And, you know, I wanted to really take Kevin's part of the program as a springboard and talk just a little bit, because I hear farmers frustrated all the time about, you know, I just need a higher price. I mean, that's the answer to this conundrum that many farms find themselves in. If I had a higher price, everything would be okay. While that's probably tautologically true, that may not be really realistic. And, you know, we find ourselves in situations where we need to make some changes, want to do some things differently. And so I thought I'd explore that. I'm going to share my screen just a bit if I can. Advanced sharing. I'm not sure that I have control. There I go. Okay. Everybody can see that, I would assume. One thing that we have to acknowledge is that milk, like a number of other things that we are producing, the business that we're in, is a commodity. It's hard to differentiate it. I mean, Apple can come out with a new iPhone and they can charge, you know, pretty much what they want to try to maximize their profits. They will sell as many as they think they can at those prices, and they have a real determination over what the price of that product is that they're going to be trying to sell. But milk is a commodity. It has these characteristics. It's very perishable. So we have to get rid of it on a daily basis. It's also bulky. If I don't like the price that's being offered at the plant that I'm selling it to, it costs a lot of money to move that product down the road, maybe another 50 or 100 miles to get to a different plant. And I may not get a much different price even if I did. We also have these very expensive and specialized assets to produce milk. I mean, goodness, take a milking parlor. You may have $250,000 invested in the milking parlor, and you can't do anything with that. It's not quite like a planter that you might be able to use for soybeans one year and corn the next. It is a milking parlor for dairy cows. You're not going to put sheep or goats through it. It's just a milking parlor for dairy cows. And we produce this milk 365 days a year, and many more farmers than we have buyers, processors. And this collection of attributes of milk has historically led to what we observed as being destructive competition. In other words, we had buyers of milk that would say back in the late 1800s, early 1900s, I know I paid you a nickel a quart last month for your milk, but this month I can only pay you 4 cents a quart. And part of the reason they were doing that is because processors were competing against themselves for market share. And about the only way to distinguish a product that was white and cold and the product of milk that they were selling was by price. And so we had this downward spiral on prices. This is why most major milk producing countries have had some kind of regulation at one point in time along the way to help find price or modify price or set a floor under prices. And we've had that since the 1930s with our federal milk marketing orders. Now, it's not the price, it's a price floor that they're putting under there. But because we still can't appreciably distinguish my product from yours, we all get about the same price. And federal milk marketing orders do something called pooling that tries to make sure that is the case. We do charge differently for milk depending on how it's been used for plants that are participating in a federal order. But farmers are all going to receive something fairly close to the same price. Despite what Kevin showed, there are differences, and I would be the first to acknowledge that. We've also had a very uncoordinated supply chain in the dairy industry. And by that, I mean that, when we have a year of strong profits, Kevin didn't show that on his graph, but if he would have gone back one more year to 2014, the data would have looked very different. For all these farms. I mean, same farms most of the time are in the same group of top third or bottom third, but not always. And you would have seen that everybody would have been well up. That very profitable year from that very high milk price we had in 2014 was the marketplace sending a signal to dairy producers that we want more of your product. And the problem that we have with an uncoordinated supply chain is that 30,000 independent businessmen are making the decision to produce more milk, and collectively we can overshoot the market needs sometime. Apple is probably not going to produce any more iPhones than it really thinks it can sell at $1,000 a pop. So that's not always true with a commodity market like corn or soybeans or milk. And as Kevin was pointing out, there are some ways in which we can look for greater profitability, but really the only meaningful path through to greater profits is either through lower costs of production or really perhaps producing a somewhat higher valued milk, such as organic. And, this is, what do we expect? This is just a simplistic graphic that's showing you on that vertical axis cost of production. Is it high or is it low? On the horizontal axis, it's showing you farm size, small farms, larger farms. And this area that I've just kind of grayed out down there is where we want to be. Under a commodity-based program, we need to produce relatively lower cost of production milk. And I think that if we would say, what do we expect? It might be something like this, that smaller farms have high costs of production and larger farms have lower costs of production. But I think that if you look closely at Kevin's work or that he just shared with you, that's maybe approximately true, but not entirely. In point of fact, the data shows something like this, that we have low-cost farms in all farm sizes. We also have high-cost farms in really virtually all farm sizes. What this is showing you is that the tendency is that indeed, as we get toward larger farms, we seem to have lower costs of production, but it's a bit misleading, because if you wanted to look just at this bottom tier across here, we do find that there are farms in all herd sizes that achieve pretty low costs of production. They may do it in different ways. For instance, these large farms may use their assets very intensively, whereas small farms might use their labor fairly intensively or something else to achieve that low cost of production. But this is essentially what Kevin's data, I think, was showing us. And by the way, this is not a hard and fast line that says everybody above here is losing money, but this is just a graphic to try to show that in fact we do have areas where we can have rather consistent profitability, and we can have areas where we have consistent challenges across farms. This is the one thing that I see. But by the way, this previous slide right here, I think with this arrow in it, is what we hear a lot of. And that is that there are returns to scale on farms, that your goal should simply be to become a larger dairy farm. And I am not telling you that that should be your goal, because that's not the only way to achieve low costs of production. There are other ways to do that, or a greater profitability. But there does have a tendency for larger operations to be lower cost on average. There are some returns to scale. But this is actually what I think I've seen from a lot of farms where you have a producer that graduated from college or came out of high school and back to the farm. We all have a chance to display our abilities as managers and decision makers along the way, and working with the assets that we have. If you happen to be a good cow manager and you work hard, even with a relatively small farm that you may have come back to or purchased, you've got profit and you've got incentive to do more of that. That's what profit really gives us. It's an incentive to do more of what we've been doing. So in that small farm, you may then say, well, I want to add some cows. I want to go from 80 cows up to maybe 200 cows or something like that. So now we've got a mid-sized farm operation. We've got a different set of skills that are probably needed. Sure, cow management and decision making, but at a mid-sized farm, we've now got employees and more employees that we have to manage. And so you have to become a good people person and good at managing those folks. And if you do that well and make good decisions along the way, you've got additional profit and additional incentives to do even more of it. And, if that's the case, maybe you go from your 200 cows to 1,000 cows. And now perhaps we're at something that we might call a large farm. If you are now good at managing the finances of the business and managing larger business decisions, you probably are hiring a herdsman at that point in time who's taking care of the cows. You may not be doing that yourself. If you're large enough, you may even be hiring your HR people to manage the employees on the farm and take care of that. But you now have additional profits and incentive to do more of it. So this kind of progression has nothing really to do with economies of scale. This has to do with success that's been found along the way. And along that way, you've become large. If I had to just kind of throw out a Stevenson estimate of things, I'd say maybe there are 10% returns to scale on dairy farms. And the rest of this is this self-selection that occurs by better managers. We have a tendency to become larger over time. And indeed, that's the case. This is the dairy farm numbers in the US for licensed dairy herds. And you'll notice that, go back to about 2000, the year 2000, which may sound like a long time ago for a few of our younger viewers, but for folks like me, that wasn't long ago at all. We had 75,000 dairy herds back then. Today, we've got less than 35,000 dairy herds in the US. So we have had a continued erosion and selection out of our dairy herds for those who simply couldn't achieve some degree of success. Now, decisions, I think, are interesting as to why do you choose to go out of business? Sometimes it's not just because a banker or somebody else told you you no longer have access to credit, but Cornell had done an interesting study on farm exit, and the data revealed a lot of different kinds of reasons. As you look at these things, I want you to just maybe think a little bit about the tendency for farm size for these different reasons of farm exit. Would it tend to be smaller farms? Would it tend to be larger farms? Age. That's going to get all of us. It doesn't matter if we're a large farm or a small farm, but a farm that actually goes out of business is probably one that's not talking about succession. They're thinking about retiring those assets from the dairy industry. And, average age was the number one reason that farms exited the industry itself, not just succeeded to a new generation, but exited. The second thing, interesting to me, Kevin, was return on equity. It wasn't return on assets, it was return on equity. So that net worth that I have in my business here, if it was not generating enough return for me year over year, then I may have made a decision to exit the dairy industry. I could put my equity to use or maybe not have it eroded so badly by not milking dairy cows. The third reason was hired labor expense. And, this perhaps you can think of hired labor just as an expense category, and perhaps it got out of control on your farm and you simply couldn't manage it and decided I have to step out. But I think that there's a likelihood that this could be the case, that rather than hiring just incidental labor or a single employee on a smaller farm somewhere, if you got to the place where your trusted long-term employee quit and you just had a hard time replacing that person, then you just decided, I'm out of business too. I don't want to do this. It's no fun anymore. Non-farm net worth was the fourth reason that farms exited. So if you were beginning to erode the net worth that you had outside of the farm, that was a reason for exiting the dairy industry if you were having to transfer that net worth to the dairy to support it. And the fifth reason, the last one I'm going to share here, was variability in milk price. So if milk price was too volatile, too much up and down, in those bad years, if I couldn't control costs or didn't maybe use some of the risk management instruments that were available to me, as well as other farms had done, then I just decided this is too much stress. I don't want to be in the industry. And the last one was machinery cost. Again, sometimes we get down to where we need to recapitalize our business, and replacing machinery cost looks like a big hurdle. And if I have a decision point to make, either replace a lot of equipment or just, sell it out, then that may be a decision point for some folks too. So if we look at the census of agriculture, here's a progression of what we have seen over time. The blue bars in here are showing you herds starting in 1997. These are census years. Of the blue bar is showing you herds of 10 to 100 cows. Orange bar is 100 to 500 cows, and the gray bars, the small caps on top of these columns, are showing you herds of more than 500. Easy enough to see that 10 to 100 herd size has been diminishing over time. Maybe you can see it with those gray bars, the larger dairy farms on top. That is growing. It's a thicker band on top over time. And the intermediate size farms of 100 to 500 have shrunk a little bit, but they've been more or less stable over the last few years. Some of that with graduations from a smaller herd size up. This is the change, however, in the cow numbers represented by those different herd sizes. Here, I think it's pretty clear to see that the larger herds, although a very small cap in total in the gray bars from the previous slide, are representing the vast majority of cows today on dairy herds across the country. So things have clearly been changing. This, in fact, is a slide that I've concocted. They've started to, or stopped sharing this kind of information at USDA, but you can estimate it relatively closely, and especially through census years. And what this is showing you over on the left-hand axis is total milk production. If you follow the very top of that green bar area, that's total US milk production for a year. And the band in there is showing you how much of that production is coming from different herd size categories. So at the very bottom, you can see this thin little blue line down there. That's 1 to 29 cows. I'm old. You can tell by the gray hair I have on my head. But when I started in the business, it was common to see herds of 30 cows or less. We don't see very many of those today. And likewise, as you go up through the progression of all these herd sizes, the one thing that I want to really let you know is that the only two categories in this entire spectrum of herd sizes that have been growing milk production, contributing to the total volume of the US, clearly it's the 2,000 cow plus herds, but also that 1,000 to 2,000 cows band. Everybody else has either been more or less static or shrinking. So it's very clear that a lot of milk production is coming from the larger herds in this country. In fact, the brown and the green bands in there right now represent about 2/3 of the milk in this country being produced by those less than 2% or about 2% of the herd numbers. So, I think I've flipped through my slides. That was a place that I kind of wanted to leave us off, to just say that structure's been changing. Some of that's been due to opportunities and growth in herd sizes, but a lot of that has been, really based on the stuff that Kevin has shown us as well, the profitability and how that's being generated on farms. Sometimes through lower costs of production, sometimes on better milk prices. And Kevin, I know that on some of our smaller herds in particular, they may be organic and getting that higher price. That's certainly the case in most of our data where we have a high price. But we also see that there are some farms that are being paid more, even if they're not organic, because the plant's customer wants farms of a certain type. They want to know that the farm is smaller, that they have treated animals well, they've certified that the milk is produced under certain kinds of conditions. So that premium can be large, as much as $1 a hundredweight. And that, Katie, is what I had. Maybe Kevin has his path forward.
Yeah, thanks, Mark. So just wanting to note, on your progression slide that you had back in there, really it's the management of the owners of those operations that kind of that they're seeing that success, that profitability, what have you along the way. Anything else you want to add to that?
Well, and I would put it into here. Kevin mentioned it, and I mentioned it maybe very quickly, but risk management in today's environment of volatile prices, I think, is pretty key. So if you're a smaller farm and you're feeling like, wow, there's just all kinds of things assailing me, I would say, look at the dairy margin coverage program. It's inexpensive, it's easy to use, it's incredibly approachable. And, now you may have invested in a 950 margin, which has to cover non-feed costs on the farm. But frankly, at 950, I think that's pretty generous. And if you're having trouble making money at that, then you probably really do need to look at some of the management decisions on the farm. And what is your milk production doing? What are your animal health characteristics like on the farm? Just a host of other things. So that's a simple first step for smaller farms to do.
Great. I think that's some good feedback that I'm sure farmers hopefully will appreciate and take to heart as we look forward to 2021. So with that, I think we'll switch back to Kevin Bernhardt. And Kevin, can you give those farmers a path forward and something to look at as they're sitting around their kitchen table tomorrow morning?
Sure. Okay. Thank you, Katie. And thank you, Mark. I always learn something new every time I hear you speak. So I appreciate getting that kind of that 10,000 foot view of things. I'm assuming, Katie, you can see my PowerPoint? Yes? Okay, super. All right, so we're starting to get to the end of the hour, so I'll go through this fairly quickly, but I would like to look at potential paths forward, and it's not just for 2021. I think this is probably true for any year that we have. Oh, I got to get this to work here, right? There we go. So the path forward, this is going to ultimately end up being a flow chart after I show the rest of it here, but it starts with understanding where you are at with respect to long-term viability of your farm. Do you think you as a manager, your team, your employees, the infrastructure around you, the cows you have, the natural resources, is the capability there to turn out profits more often than not? That's long-term viability or not. So there's multiple reasons why you might answer no to that question, and it may have nothing to do with your management. There may be lots of reasons why. Mark alluded to some of them. The age you're at, the age of your machinery, the age of your barn, and so forth. You might be at a place where you just don't want to go through that recapitalization, for example. So there could be lots of reasons for that. That's not a statement of whether your management's been good or not. But anyway, the question is there, long-term farm viability. If you say yes to that, and if you think you've got a good, strong ag economy coming up in the future, then it seems like what you might be looking at is, how do I grow this operation? I don't mean grow necessarily in terms of size, but I can grow in size. That's one option. Or I could grow in scope. I could do some different things with the herd that I have. Multiple products. Those might be animal waste products. Those might be products that are taking the processing of that milk, whatever it might be. I could do other kinds of things with the farm resources I have, agritourism or whatever. But anyway, if I have farm viability, if I think the economy is going to strong, I have some options to now take on some of those strategic initiatives to take my farm to the next step, to the next level. And that's where I want to focus. Now, if I have good viability, but I think I'm facing a weak economy, now I'm in this camp that we've labeled the long haulers. That means you're in it for the long haul. You're going to be here. You plan to be here for the long haul, but you got a weak economy here at the moment. And so you need to cash flow the operation at this point to get back to the other side, so to speak. In fact, one of our Farm Management Fridays coming up is going to be talking more in depth about this long hauler group and the cash flow that goes with it. Whichever these are, your options beyond then is to look at strategic growth, whether that be in terms of size or in terms of scope, in terms of efficiencies on your farm, continue those operations, or maybe you want to do some redesign. You have the options there if you got that long-term viability and you've got some money to spend. On the other hand, you might ask yourself, do I have a path forward that doesn't look so good? Because of my infrastructure, because of whatever reasons, I'm just facing, I think, some tough challenges with respect to being able to consistently and continuously turn out profits. If that's the case, then we put you in this camp called guardian transitioner. And that means that you are the guardian part is you want to guard your equity. You have built some wealth in this business in the past. If you think you're facing a future where that profits are not going to be there, in fact, you might start losing some of that wealth, then you want to guard it. You want to guard against losing that wealth that could be used for other reasons. And so that means transitioning to something else. It might be still transitioning to something else in agriculture, or it might be exiting completely and transitioning to something else that's outside of agriculture. But there's a good way to do that. There's a bad way to do that, and that's to ignore it and let it happen to you. And there's a good way to do that. And there's lots of examples of people who are very happy in what they have done as they transition to something else to guard that equity. So if you kind of dig this little format here as what my different paths forward might be, the first question you have to answer is long-term viability. And I'm just going to mention that real quick, this long-term viability piece. What do we mean by that? What do you have to look at? And a lot of these parts have been mentioned already today, Katie. But I kind of look at that three-legged stool there, that you have to have these three elements in order to have long-term viability. The first one is capacity. And capacity is the ability of this farm to turn out enough product to be able to achieve the profit goals that you have. And that depends on what kind of business model you have. If you're an organic farm, that's very different than being a large farm that's depending on a commodity, for example. But do you have enough milk? Do you have enough corn? Do you have enough organic milk? Whatever it might be, do you have enough throughput to be able to achieve your goals? That's part of long-term viability. The second one is performance, and that comes back to your question earlier, Katie. Am I growing wealth? Do I have profitability as measured by the return on assets, return on equity, as Mark mentioned, et cetera? Do I have financial performance there that I can hold up my viability? And the third one has been mentioned as well, and it's one that's often forgotten, but it's resilience, and that's this risk management piece. Do I have the ability to, does this farm business have the ability to take a hit? That hit might be prices. That hit might be a death of a manager or disagreement among managers. It might be a weather type of hit. I mean, obviously this past year we learned about the black swan events that can happen, pandemic, and we're not going to have that every year, thank goodness. But they do happen. Something happens. Trade agreements. We have a new administration coming in. What does that mean in terms of trade agreements with our exporting nations around the world? So, that's the resilience piece. Do I have mitigation strategies in place that keep the long-term viability of my business in place? That's management, by the way, Katie. That's, putting those mitigation strategies in place, recognizing what those potential risks are, mitigating against them in ways that are cost effective. That's great management. And I think you need a balance of all three of these pieces in order to answer yes to long-term viability. So I think I'll stop there, Katie, and see if we have any other questions.
Yeah, no, thanks, Kevin. That's really good. And that really leads into our Farm Management Friday webinar series that we will be offering through Extension. Kevin will be talking about those three different legs throughout here, January, February, and March. So for those of you who have not signed up for that, feel free to visit our Extension website at farms.extension.wisc.edu and look under events for those upcoming webinar series and sign up to learn more. Now, Kevin's articles on those 3 camps are also available on that website. Encourage you to go there. Lots of information for there. So, Mark, did you have any follow-up on Kevin's path forward there? Oh, Mark, you're muted. Kevin, anything else? Well, we fix Mark's audio here at the moment.
I think if Mark was able to get his audio on, I think one thing he kind of wanted to talk a little bit is the marketing piece, the price risk management piece. Mark, are you on now?
I am.
Okay,
Forgive
go
me.
ahead.
I had a battery die.
Oh.
Yeah, another casualty of COVID. No, I was just going to say, Kevin, I think that I really like the way that you have laid out the 3 camps, kind of identifying maybe as an individual, where do I feel like I am in those camps? Am I a long hauler? Am I, on the fence, or am I a guardian transitioner? So that's going to be a useful thing to think about, and then to kind of keep peeling it down and identifying, where do I need to focus my management attention? I can't handle everything that might need to be looked at on a farm. I need to think about what are the most important things, and prioritize those and start to work on them. If it's risk management, let's do it. A lot of people think that's difficult. It's not. It's fairly straightforward, and you can go as deep as you want to on it, but some things are simple.
Yeah, definitely. Well, again, any final closing comments? I mean, we're going to kick 2020 back out the door and look forward to 2021. And hopefully what we've provided today, just get a little excitement, hopefully. And the webinar series that we have coming up, I know, Kevin, you're looking forward to really sharing that information, especially some new tools that we have developed.
Yeah, absolutely. Looking forward to that. And I'll just my parting comment would be to kind of take off from what Mark just said, and there is a huge amount of different efforts that a business needs to do or would like to do. But at some point, you only have so much time in a day, right? So, being able to focus in, I just end up writing an article for Progressive Dairy where I talked about the power of one. And the idea there is pick that one thing, maybe it's more than one, but pick that one or a couple of things that you really want to tackle in 2021 and make them happen. You got 2022, 2023, and 2024 coming up, so you can take on some other things, but get that one thing or 2 things or 3 things that you want to really focus in on and make that a resolution to make those happen as we go into this next year.
Yeah, I know that there's people out there and resources out there, for example, especially Extension. We do have educators and specialists like yourself and Mark that are here to help farmers, regardless of where we're working or what we're doing. So with that, I'd like to thank Kevin and Mark for your time this morning, and I'll turn it back over to Caitlin.
Thank you for joining us for today's Farm Management Friday on navigating your farm business through 2021. In the description to this video, you'll find a link to a short 3-question evaluation. For those who pre-registered for the event, you'll receive the link to the evaluation in a follow-up email. Should you have any additional questions or feedback, feel free to reach out to me at caitlin.davis2@wisc.edu. As Katie mentioned earlier, you can go to our Farm Ready Research website to find out more about our upcoming webinars. Join us next week on January 15th for our program, In It for the Long Haul, Cash Flow During a Crisis.
And I'm assuming we're done with the live stream.